Hey guys, welcome back to Investor Yoda. I'm Thomas Reggie Punna, and today I'm going to be talking about how you can make passive income through real estate. So let's get right into it. So when it comes to real estate, there are 3 steps that I take that help me succeed in buying real estate properties as investment properties. So the first step is you want to make sure you have positive cash flow. What I mean by positive cash flow is just that when you minus your income and expense, you should always have your income more than your expense. So how do you do that? So when you look at a property, you first need to calculate what are the common expenses you have with that property. So it's going to be your mortgage, which you're going to be setting up with the bank, and it's going to be your home insurance, or if you're going to be paying less than 20% of your down payment, then you might have a mortgage insurance. The third is going to be property tax. So if all of that covers, and if all that covers in expenses, and you still have an income that's more than that, then you have something called as cash flow. So imagine you could get a cash flow of $500 per property. All it takes is to have at least 5 properties where you'll have about $2,500 per month. So when you look at that, you'll find that when you have like at least 5 properties and each property is giving you $500 cash flow, that's about $2,500 per month is cash flow. So you're already halfway there. Like if you are, so let's say for example, if you are like, if your financial freedom is something like you want to have $5,000 per month for your financial freedom, and if you can buy 10 properties and each property is going to give you $500 in cash flow, then you don't need to work again, right? So how do you get there? So most people, I think the common issue that we face is we don't have that kind of down payment of 10% or 20% that you can pay upfront for a $200,000 or a $300,000 house today, right? Because the median home prices today is about $300,000. So what you can do is you can start with actually buying into a duplex, and if you're a first-time home buyer, you can get for a duplex for as low as 3%. So what that means is with just 3% down, you could move into a duplex of a 300,000 or a 200,000 home, and slowly you could build up equity. How do you build up equity? Is that in your duplex, you could probably rent out the other part of your duplex, and that rent could actually cover up for your mortgage, right? And then every month as you get rent, in a year, in 2 years, in 3 years, you're going to see with inflation that you're going to be getting a higher rent each year. So that extra money can contribute towards the investment for your next home. So imagine if you could do this over and over again for 4 or 5 times. By like 6-7 years, you're going to have at least 4 or 5 homes. And each of these homes are going to be giving you cash flow, and you're not going to be putting a lot of investment down because you start with just 3%. Now how that works is, like I said, first step was cash flow. Second step is what you can do is you can actually take equity out of your property. How do you do that? So initially, let's say you bought a home with $200,000 or a $300,000 home that you bought initially. Over a period of 5 to 10 years, you know that's going to increase in value, because you know even though real estate has ups and downs, an average it gives you 4 to 5% increase. So that means your 300,000 home in probably 10 years could be worth 600,000. Now you have a line of equity which you can tap into. So you can go back to the bank and say the $300,000 property I bought with just 3% down, I can go back and say I have a $300,000 cushion now because the home price is increased to 600,000. So imagine this 300,000 is just from one property. So you take that 300,000 as a loan, you're not paying any taxes on it, and you put as down payment to the next property. This is what is called as leverage. And this is a form of actually taking loan, but making sure you are actually taking a loan that is going to be your asset. You're not taking a loan for buying a car or some other asset that's going to depreciate, but an asset that's going to appreciate over time. So you will see that over a period of 10 years, you might have 5-6 homes in this way. So this is a way for people who don't have that initial 10-20%. Now the other way to do it is that if you can find a good deal, which is the third step, you don't have to put any of your money. You can tap into other people's money. How do you do that? You go, let's say you have a friend or you have somebody relative of yours who's ready to invest, but they want to see positive cash flow in this property. You can go into these 320 markets in US and find out some property in any one of these markets, and actually you can tap into like finding out properties where you might get properties below the median market value, and you can actually renovate those properties and you can rent it out for more than what the mortgage is for that property. So your friend or your relative, they might actually give you the money upfront to put for down payment. You might not have that, but you do all the work and you get like in a combined deal with them in a way that you don't spend any money from your hand. They put in the money, but you do all the work. So you can be a partner with them, and over a period of time, you can actually get money out of that real estate asset. So this is another way of house hacking you can do if you don't have initial investment. And always you can see that over a period of time, if you compare it with stock market or 401k, real estate is going to give you the most value for your money, because everybody needs home, and today we know that we are 5 million homes short, and it's going to take at least 10 years to match up with the demand of housing we have. So if you calculate over a period of 10-20 years, I have a plan. How I did it is like each time I buy a home, I make sure I have at least 20% profit I get from it. So over a period of 10-20 years, I'm actually making 27 times what I initially invested in real estate. And this is something all of you can follow, and please watch for my future videos. I'm going to be talking more about each of these. I know I've just touched the surface with home equity line of credit, or I've touched the surface with talking about taking a refinance loan with the current property. So I'm going to be talking more on that in the coming videos. Hope you guys got an idea how you can start building your asset wealth with real estate. I would say at least start today researching about it, and maybe start with one single family home today, or one unit, an apartment unit, or whatever. You would learn through the process of buying that property. That's how I learned it, and I think you can do it too. So till next time, I hope you learned something in this video, and look forward to my future videos for more on real estate. Please comment in the section below and let me know if you have any other thoughts regarding real estate, or if you have already started investing in real estate, what are the things that led you to invest more in real estate. Thanks again. Talk to you soon. Bye bye.